Hi guys, good morning. Welcome to Moneycontrol. I'm Karunya Rao, and joining me today are my colleagues Chandra, Srikanth, and Madhuchanda. We're here to talk about the IT sector earnings for the quarter gone by. The heavyweights have delivered their numbers, so we want to take stock of how the performance has been for the quarter gone by and what were the big highlights, the big trends that have emerged. Guys, thank you so much for joining in. The big question is who wins the top spot in Q1 this time around among all the heavyweights? Infosys, TCS, HCL Technologies, Tech Mahindra. Madhu, what has been your reading of the numbers?
See, there is some broad trend in the numbers, as all of you would agree. The trend is supply side issues lingering on and impacting margin. For some of the guys, as you mentioned, they had affected wage hike. For instance, TCS had their compensation revision this quarter. Infosys had a compensation revision this quarter, and that principally was one of the reasons that dented margin. But in terms of execution, I think that engine is still firing very well. For instance, Infosys, as you have seen, they have upped their guidance. But having said all this, there is some element of caution which is coming in realistically. There are certain pockets of weaknesses which they are highlighting. So, yeah, overall, I would say so far there is no stress from the demand side, but supply side issues continues to impact their performance. Of course, when we delve into details of the companies, there were some bright spots outside this, big five. But yeah, we can talk about it later.
Madhu, where is the sense of caution coming in? A lot of analysts have also turned a bit jittery about IT sector after a bout of high growth. And of course, the recession in US and Europe, which is a big risk, in the key developed markets, is something that's looming large. But how real is it? Because the commentary still seems to be not very negative or alarming.
Absolutely. See, to sum up this whole discussion, because we have had lots of conversation in the last 3 weeks with, companies of various sizes, and there is some common theme running, which is very reassuring. First of all, let us be very honest. There is no demand slowdown as of now, as we speak. There is no order cancellation. There is no deferment of budgets, etc. So, as we speak, there is nothing. But realistically speaking, if there is a deep recession in the key markets, say US and Europe, of course, US being the driver, naturally there will be caution amongst the CXOs of all these enterprises. So there could be temporary slowdown in decision making. See, we are in the midst of an upcycle. I mean, unprecedented upcycle of digital transformation, cloud adoption, etc. So this is kind of a 5-year cycle, and this is a cycle where nobody wants to leave this unprecedented demand, and that is why they are hiring at any cost, etc. But suppose if FY23, most of them have their orders in their kitty, so you won't see, an impact on earnings beyond the supply side issues. Okay, but FY24, we don't know how robust the demand will be. But having said that, there's not going to be a reversal. So any weakness because of demand side would be an opportunity for investors to ride for the following 3 years.
Chandra, I was looking at your tweet. I think you were speaking to a couple of IT analysts, and they said the earnings were pretty terrible this time around, and one should not get fooled by bullish commentary coming in from the management. So, what are you picking up from these conversations?
Karunya, I spoke to a couple of analysts, who've tracked these companies for a really long time. And I was under the impression that, these are decent earnings, revenues were in line.
Yeah.
Infosys has, in fact, raised its annual guidance. But these analysts told me, on the face of it, it looks very rosy. But don't get fooled by the bullish management commentary because signs of stresses are already coming in. Madhu, of course, addressed the margins situation, which is, a function of supply side. Their attrition is still high. Their subcontracting costs are still high. They've added record number of freshers in the last year, but it takes some time before they can be deployed for projects, which is why their subcontracting costs have also gone up. And the margins would have been even more terrible for companies like Tech Mahindra and Wipro if they hadn't deferred, compensation hikes to September. So margin side, the pain is visible across for companies. But the other metric that really caught their eye was also TCV, or the total contract value. Now, management say that, this cannot constantly grow at a certain pace quarter on quarter. It will moderate. But almost everyone has called out the fact that TCV hasn't been great for companies, which is perhaps an early sign that, there is some kind of caution creeping in, because the contracts that they are executing now are contracts that, they would have won 2-3 quarters ago or few
Yeah.
quarters ago. So the TCV they win this quarter is actually a sign of the work and revenues that will flow into these companies in the next few quarters.
Hmm.
So I think FY24 is when we are going to see this pain play out, and the bullish management commentary too may not last, beyond the next couple of quarters. So I think December quarter is when we are going to look at some of this pain creeping in, because they really cannot be insulated. Their major markets are US and Europe. US, almost everyone is talking about a recession. I think Noriel Rubini also kind of sounded out a very severe warning this morning. So, it can't be that they will be insulated from all this, even if companies spend on cost saving projects and so on.
Madhu, how big a concern is TCV wins? Because yes, like Chandra flagged off, it's not been very impressive.
Yeah, TCV win, especially for the large companies that you have mentioned, have been a tad softer. And there is no doubt, as some of the managements have alluded, that there is softness in certain pockets like retail, which is on expected lines. You have heard even in the last quarter, some of the large retail names in the US sounding cautious. And of course in the mortgage, because because there has been a steep rise in interest rates already and more are expected. Yes, so TCV was a little softer. And honestly speaking, given the size of their businesses, their size of their operation, to show growth in a challenging environment, to show growth that will meet investors expectation in a challenging environment, is going to be difficult for larger companies. Although I would think that Infosys is a little better placed. But for instance, the numbers from Wipro, the numbers from Tech Mahindra were quite disappointing. It was all around disappointment. And in fact, I had come in your show and I had, sounded out that I'm not too comfortable with Wipro because stitching so many acquisitions in a challenging environment is difficult. In fact, Tech Mahindra has also resumed that inconsistency. Tech Mahindra's earnings were always marked by inconsistency in the past, and that inconsistency has again come back. So, pretty negative on those stocks. But yeah, there are smaller businesses which have not seen so many headwinds like the larger ones.
Would you like to highlight these businesses?
Yeah, there are certain companies which from MC Pro we have recommended as our high conviction picks, and they have continued to surprise positively. One being Persistent System. In fact, they have had their record order booking in the quarter. Even Coforge had very, very strong quarter. Their margin dent was because they had taken compensation revision, which is higher than usual for all companies across the board. And even I would think that, LTI had called out some very interesting large deals. Even Mindtree numbers were good, although LTI Mindtree, there is an overhang of the impending merger, but I think they had put up a much better show than these top five companies that we have discussed so far.
Agreed. Okay. Another leading indicator of how the sector and many of these IT giants are performing is the hiring trend. And most IT companies have also slowed down their hiring. And at the same time, of course, attrition levels, according to our reports, remain high. Chandra, what is the trend like? Because from what I understand, Infosys is on the higher end of this and TCS on the lower end. So overall, what is the position of the industry in terms of hiring trends and attrition?
So hiring, Karunya, I would say it's a mixed trend because for TCS it went down sequentially and year on year. But if you look at Infosys, they've actually added 21,000 people. They have an annual hiring target of 50,000. But again, for Infosys, the attrition number is also very high. It's 23 to 24%. And then again, if you look at Wipro, they also added a good number of freshers. So on that count, it's kind of been a mixed bag. Some companies, went ahead and hired in good numbers. But if you look at TCS, they struck a slightly more cautious note in their hiring numbers. But you must also realize that the previous fiscal, right, which is FY22, it was really a record hiring year for these companies. So lot of freshers have already come into the system, and they are being kind of trained, and they will be deployed in projects as we speak. So if the TCV wins don't improve, the contracts don't improve, there's no reason for these companies to keep hiring at the same rate, because even if you look at their utilization numbers, I think many companies are still in the 70s. Madhu can maybe correct me if I'm wrong here. So they have that headroom to take up utilization, to deploy the freshers who they already hired in the last year, because last year was clearly a record hiring year for all IT companies.
Madhu, you want to add to that?
Yeah, I mean, absolutely. See, there is some bit of a buffer with many of the companies, and if you see, there is still a big gap for many companies between the utilization, including training, and utilization excluding training. Include utilization, including the trainees, are quite suppressed, which means that they still have headroom to deploy them. And I think there is one strategy which is playing at the back of many of the companies. They have this comfort of utilization going up, and most of them are running on very high subcontracting costs. And the way they want to play it, that should demand slacken, they are going to take the subcontractors out of the picture, and they are going to put their own resources, and by that they will get the benefit of the pyramid, which could be a slight kicker for the margin for them.
Okay. What has also been a positive surprise, Chandra, like, you said that in analysts you spoke to are not very sold on the commentary, but most of these companies have either retained their guidance, or in case of the likes of Infosys, where they have raised the revenue guidance as well. Uh, does that help in terms of sentiment at all when it comes to visibility in earnings for the rest of the year, and investor confidence as well, perhaps?
Karuna, it is intriguing because these IT companies traditionally had this history of under promising and over delivering. But this quarter, they seem to be over promising, and it doesn't kind of show up in the numbers. And one analyst I spoke to brought up a very important point. He said in many of the top companies, the executive compensation is now tied to total shareholder returns. It is ultimately in the CEO's interest to sound bullish, to sound optimistic, not just to their external stakeholders, but also to their internal stakeholders and their executives. But if you actually try and square the over optimism that we heard, especially in the case of Wipro and Infosys, at least during their press conference, it doesn't really seem to square with their TCV wins. And Wipro, yes, on the face of it, their guidance 3 to 5% was ahead of street estimates. But Wipro has spent nearly $3 billion since Thierry Delaporte took charge on 10 acquisitions, and they didn't break up their organic growth guidance, inorganic growth guidance. So if you take away their acquisitions, their growth will tell you a very different story. So I am not sure if management commentary still serves as a very good barometer of how an IT company is going to perform. I mean, it used to be a very good indicator, but now can you really take it as at face value if the executive compensation is dependent on TSR?
Okay, all right. Madhu, if we look at brokerages' reactions after the numbers came by for most of these companies, analysts have either maintained the neutral call, or some of them stuck their neck out and went for a buy rating for these companies. I was reading a Moneycontrol report as well yesterday, and it said that most analysts believe that Infosys is the most well positioned to deliver stronger growth going forward. It has the most amount of visibility in terms of earnings as well. Do you concur with that, or does MC Pro have a different list of their favorites in the IT space?
Um, so I will just summarize my understanding from whatever analysis we have done and interaction with the management of these IT companies after the Q1. So, what they are communicating essentially, which is, I'm not talking about the gaga statements of, demand looks normal, etc. But I'm saying what they are essentially trying to communicate, the fact that, this strong demand trajectory is not going to go away completely with a recession. Okay, that is the first point. The second point is, very tacitly, the senior management of many companies are acknowledging that there could be a slowdown. So yeah, you please take it as a FY24, a possible slowdown, which is still not there in all of our estimates. Of course, we have from MC Pro, we have kind of tried to tweak our FY24 estimates according to this caution. But is it going to be something like a GFC where multiples valuation multiples collapsed? The answer is no. We are still in the middle of a technology upcycle with a pause because of the macro slowdown. So what
Yeah.
could happen, and that is what we have recommended in most of our notes, is the valuation will move back to the pre-pandemic level. So just to give you an example, say for instance, today TCS is trading at 26 times 1 year forward. Okay. The pre-pandemic valuation was 20 times. So what you could see is a 15 to 20% correction from this level to make the stocks really attractive.
You've actually answered my question, because I was going to go in that direction, because you're saying we're in the middle of a super cycle or an up cycle for the IT companies, but many of these stocks have corrected a fair bit. Clearly, you think there's more room for a
Yes, because
downside, and
see,
yeah,
yeah,
go
see,
on.
because as of now, analysts have still not factored in the 24 FY24 slowdown there in their earnings estimates. Okay, if you factor in the slowdown, then the valuation looks heady on FY24 basis, right? So, and we feel that if there is some pause, there will not be a reversal, which we fully agree. Because if you are in the midst of a digital transformation for your company, you're not going to abandon it altogether. You
Yeah.
may say that, you prioritize this project in FY24. Let us not spend on that particular bit this year. That kind of a rationalization can happen. Growth numbers are going to be less impressive in FY24. If should this happen, we don't know. No, macro can go anywhere. But
So
should that
next
happen,
couple of quarters will
valuation,
be important to watch.
sorry.
Next couple of quarters definitely will be very
Absolutely,
critical.
and you should closely watch the data point which is coming out from all over the world, and what their principal enterprises are saying. But what could happen is a multiple derating to pre-pandemic level, where we see a 15 to 20% downside. But this is all contingent on where the macro goes.
Chandra, what will be some monitorables that you will be closely watching out next few months? Because both of you are kind of sounding off each other's thoughts, and FY24 onwards, clearly it will be important to see how things will play out. And in the next few months, we will get to know where we are headed.
Right. So, like Madhu said, FY24, is what analysts are saying when, the pain will kind of start showing. And maybe December quarter is when it will perhaps become more tangible. I think I will watch out for the hiring numbers. Will they revise hiring targets? Will they perhaps, look at restructuring compensation? Because the last year we've seen bonuses, comp hikes go up. So is this a chance to kind of cost cut? So hiring numbers is one. The contra view is that high attrition actually is good for the IT sector in some sense, because it also shows you about the demand. So I think attrition numbers also, we will kind of monitor. So I think hiring number, attrition number, TCV for sure in terms of total contract value that the deals that these companies are getting in the next few quarters. I think those will be the key monitorables for me. But margins, I think, should hopefully ease since the wage hikes and all are over now, and subcon costs will also go down. So, I mean, I think margins have bottomed out for most companies.
All right, so lots to watch out for in next few months. Definitely very, very critical for the IT sector to see where the entire industry is headed and how the earnings performance will be for the next fiscal as well. Guys, thank you so much, Chandra and Madhu, for taking time out and chatting with us in detail about Q1 report card review and what perhaps could be like ahead.